All right, let's talk about audit risk and basically how audit risk affects certain areas called financial statement level and relevant assertion level as far as how we're looking at responding to the level of risk. Now, in your notes it says audit risk. We've covered this. Let's talk about it again. Audit risk equals what? IR times CR times DR. So as we said, audit risk equals IR times CR times DR. So that means audit risk, the risk that you give the wrong opinion on materially misstated financial statements, is inherent risk times control risk times detection risk. In solving for detection risk, we said audit risk over IR times CR equals DR. IR, CR together is risk of material misstatement. So as we look at this, as this goes down, this goes up. That means as your control risk goes down, which means internal control doesn't look good. That means you don't think you can rely. Therefore, your detection risk goes up. So as we say this, we're saying, okay, if reliance is high, that means this is down, control risk is low, RMM is low. We're willing to let our DR go up. We're going to do less substantive testing. The other thing we said, though, is the opposite, which is if reliance is low, control risk or RMM is high, which means we want, and the only risk you, the auditor, control is your acceptable level of detection risk, how much risk you are willing to accept. So if DR goes down, that means you're going to do more substantive testing. So there's the inverse relationship. So that's what we're looking at here is, again, audit risk, IR times CR times DR. Solving for DR affects the nature, timing, and extent, what, when, and how much substantive testing you're going to do. So it says here, audit risk, RMM, is IR times CR times DR. Talked about that. Now DR, which we're going to jump into today in detail, detection risk, whoops, DR, detection risk, is the risk that you, the auditor, do not detect the issue. So it says detection risk, the probability that the auditor's substantive tests will not detect material misstatements. So if it will not detect material misstatements, what does that mean? What it means is that the risk you're not going to detect it while you're doing either TD or AP. What does that mean? TD is test of details. AP, analytical procedures. TD is the risk associated with test of details, that they will not be effective in detecting material misstatements. AP, that risk associated with analytical procedures will not be effective in detecting material misstatements. So what it says is, as you'll see over here, we're talking about these things called your test of details of accounts, transactions, and balances. We're going to learn later that there's two different types of substantive tests. What are they? Tests of details, T of D, the tests of details of accounts, transactions, and balances, and analytical procedures. Those are the two types of risks as well. So detection risk means the risk you don't detect the error while you're doing your test of details of accounts, transactions, and balances, and while you're doing analytical procedures. So that is your DR, that is your detection risk.